Well, good afternoon, everyone. Welcome to our usual mid-year fall investor update call. Today, we actually delayed the update a bit since we wanted to wait for the outcome of the presidential election here in the United States. And you see a different form of an agenda here with the election update being the #1 agenda item. And I think this is the most important thing. What I want to leave investors with is really give them a little bit of overview on how the election in the U.S., what implication it will have on the healthcare sector and the worldwide healthcare trust in particular. I will hand it then over to Trevor for the investment themes and talk a little bit about the performance. And I take over then on the portfolio and positioning. We have made some important changes here in reflection of the outcome of the presidential election, and I will elaborate on that. And then I end with our playbook, and we're going to start the Q&A session. So, going into the election, the market consensus, especially by healthcare investors, was that we will have some form of a split Congress. So either we would have a Republican president, but Democrats get control of the House, or we would have a Democrat president with a control by the Republicans on the Senate. So this was the consensus, our outcome expectations. And with that, market expectations were that very little would happen with a split Congress for the healthcare sector. There was, however, a fear of a possible Democratic sweep. And I think this was really what held back a lot of healthcare investors to investing more money because they were fearful that, hey, what happens if we have a complete control of Democrats in Congress? Do we see more healthcare reform, more drug price control? So that was really a very important overhang. But obviously, with this, with the outcome of the presidential election and the complete sweep by Republican, that overhang got removed. And when it comes to the healthcare sector, the Republican victory, I think there is a pretty broad consensus. It's a big win for healthcare stocks. And maybe take a little bit of a step back and look at the past three administration, what we had over the last few years. And you see here during the during the Barack Obama years or the Joe Biden years, typically the market perceived it as neutral to negative for the healthcare sector. I think in both times, Barack Obama was signing off Obamacare, the Affordable Care Act in 2010. This was a major overhang during that time period. In 2022, we had the Inflation Reduction Act under the Biden administration. And this has created quite a bit of an overhang there as well. And this was for the first time it gave the US government the ability to negotiate drug prices. So I think both times, when Democrats were in control of the presidency and the Congress, this was perceived by the market as neutral at best to negative for the healthcare sector. When we had the first Trump administration, I think in general, it was a more favorable environment for healthcare because there was no negative major healthcare reforms on the horizons. Now, Donald Trump is a populist, and he always talks about drug prices as well. But overall, I think those years, the political backdrop was perceived as favorable for healthcare. And this is very important now moving on to the next page. So what's the outcome? What's the implication for healthcare from the outcome of the presidential election? And you see there, it's mostly positives. There are some negatives and some a little bit of uncertainty, but overwhelmingly, I think the outlook is positive as a result of the election. So first and foremost, the overhang is removed. This has been now for a number of years an overhang on the healthcare sector that drug prices were coming down. The government would negotiate drug prices. And I think that fear and this overhang is now resoundingly removed. The second and really a near-term catalyst for the sector is on M&A. Now we have the head of the FTC is appointed by the executive branch. So the current head of the FTC, Lina Khan, was appointed by the Biden administration, and she was very negative on any form of M&A, both in the tech space or in the healthcare space. And the U.S. government actually tried to prevent the merger of Amgen and New Horizon. But now Lina Khan, this will be one of the first executive actions. She will get removed, or she will most likely quit here in the very, very near term. And I think this will open the floodgates to more M&A inside the healthcare sector. Now, traditionally here in the past 4 years, most of the M&A was on smaller cap biotechnology companies, especially in response to Lina Khan. But now I think there is a possibility as well of larger acquisitions north of $10 billion. So this is very important positive catalyst, and it's very near term. We have a major healthcare conference in January, and typically in the run-up to that healthcare conference, we will see some M&A transactions. So hopefully we're going to see a repeat of history there. We're going to see quite a few transactions going into January. I think the third point, and the very, very important part, is the executive branch appoints the leadership of all of the major healthcare regulatory agencies. So Department of Health and Human Services, HHS, CMS, FTC, FDA, CDC, NIH, they will probably all get new leadership appointed by the Trump administration. I think that new leadership will be significantly more industry friendly, and I think implementation of a lot of the new policies and new laws will be done by Republican-led leadership, and I think many of those new proposals will be watered down and will be more industry friendly. And obviously, I think we will see an extension of the tax cuts. So I think this is great for the bigger profitable pharma companies as well. They will have, under a Trump administration, lower overall taxes. And I think on innovation, I think the current Trump administration will be, I think, quite favorable towards encouraging innovation. J.D. Vance, during the election campaign, has many times issued positive statements on how they want to be very supportive of innovation in the healthcare space. And then the very important part is obviously the implementation of the Inflation Reduction Act. This was implemented in the summer of 2022. And this IRA Act gave the US government, for the first time, the opportunity to negotiate drug prices, and there could be major changes to the IRA. At the moment, our expectation is that the IRA will stand, so we will have some form of negotiated drug prices by the US government going forward. But there could be very, very important changes on the there. So, for example, like small molecule drugs have an exclusivity period for price negotiation of only 9 years. Biotechnology drugs, the exclusivity period is 13 years. So, for example, we would not be surprised if this would be with under a Trump administration, where small molecule drugs would be equalized to biotechnology drugs, and there would be a 13-year exclusivity period. So this overall, the positives are very, very favorable in general for the healthcare sector. So what could be negatives? Well, RFK Jr. is a little bit a dark horse. As you may know, he will play a role in the new Trump administration. Trump has been quoted as he will let RFK Jr. run wild on healthcare. He has been an outspoken critic of vaccines. It is unclear what position he will take in the new Trump administration. It seems like he will probably focus on possible vaccines, but probably more on the food aspects of the regulations. and that the drug part of the FDA will probably be unscathed by RFK Jr. But this is a little bit an unknown quantity, and we will have to wait and see. And uncertainties are, I mentioned it already, Donald Trump is a populist. Drug price controls are a very populistic endeavor. You know, everyone wants to see lower drug prices, and Trump is not against it. So he has been in the past has been talking about that drug prices are too high, but nevertheless, I think the positives of an executive branch controlled by the Republicans far outweigh any negatives. And I think this is going to be a very important catalyst for the healthcare sector, that we do have a Republican administration in complete control of Congress. Now, we have talked in previous calls and at the annual shareholder meeting about the new IRA, how the U.S. can, in the U.S. the government can now negotiate the drug prices. We had actually in this fall for the first time, you know, the first set of 10 drugs, the drug prices were negotiated. Here you see, you know, from the list price, you know, the average negotiated rebate is 63%. But, you know, the list price and the true market price is very different. You know, estimated current rebates from the list price is 50% already. So the government negotiated drug price is not that dramatically different from actually the current net prices what drug manufacturers receive. And the investor expectations were significantly worse, 65 to 80%. So this was actually a good outcome. And this was under a Democratic administration and under Democratic control of CMS, which is in charge of negotiating the drug prices. And then maybe, Trevor, the next page. This is like the timeline of the implementation of the IRA. So for the first 10 drugs, the drug prices were negotiated this fall, but the first time that we will have actually the impact of the drug prices is in 2026. We will have another set of 15 drugs getting negotiated over the course of next year, and this will be done under Republican leadership, and this will be very interesting. How would Republican leadership at CMS negotiate the next set of drug prices? And then you see as well 26, 27, throughout the implementation of the new drug prices, we will have Republicans in control of Congress and in control of executive branch. So there is a very good chance that there will be some watering down of this process. And I think this is pure upside for the sector. It is not discounted in the share prices. And this is what makes us, I think, very enthusiastic right now about the opportunity in the healthcare sector. And here, the next slide, this shows you actually what has the healthcare sector done vis-a-vis the broader market over the past 2 years. The IRA, the Inflation Reduction Act, has been signed off in August of 2022. And you see here, 23 was actually a record year of underperformance of the healthcare sector. And here, XLV, this is a broad healthcare ETF. The XBI is the Emerging Biotechnology Index. And this was a record underperformance in 2023. This year to date, again, very significant underperformance of healthcare and biotech vis-a-vis the broader market. We think the healthcare sector is way overdue for a significant reversion to the mean. I think healthcare will catch up with broader market indices. We are trading at a huge discount here to the broader market averages. And this, together with the wind in the back of a Republican executive branch, I think is an incredible, interesting setup, I think, for the worldwide healthcare trust. With that, I hand it over to Trevor.
Great. Yes. Thank you, Sven. Moving to investment themes, my commentary today is predominantly going to focus on what we're excited about for the remainder of 2024 and into 25. But really, it's what Sven and I have been discussing with investors since earlier this year. And let me start with biotechnology, as the underperformance there has been under real scrutiny over the past 5 years. The chart on this slide depicts the XBI, which is the ETF that we use as a proxy for an index of mid-cap biotech performance here starting in January of 2020. And you can see the dramatic rise of the XBI in the first year of COVID to the launch of the COVID vaccines in early 2021, which really marked the peak of the biotech sector. Then the subsequent record-setting drawdown into the middle of 2022. But more importantly, since that time, biotech has turned a corner, and that's including a healthy bounce off the bottom just a year ago, as a lot of the macro headwinds that have conspired to put a lid on biotech performance are seemingly behind us now. And that includes what Sven was just discussing, the most recently concluded US presidential election. But what has really been the key to the turn? Well, outside of interest rate debates, the real key has been the reflection of M&A across the biotech space, which really inflected in April of 2022, as you can see here by that yellow star, and has been accelerating since then, culminating in $100 billion worth of deals just last year and a very brisk pace so far in 2024. And we've overlaid OrbiMed's own proprietary M&A basket on this slide here. And since that time, it has outperformed the XBI since M&A has really started to accelerate over the last couple of years. And let me drill down on that here a little bit here. Again, it was April of 2022 was the first time we constructed our biotech M&A basket. And it's very important to point out, this is a proprietary swap basket, which we handpick mid-cap biotech companies that we believe are ripe as M&A targets for a variety of reasons, whether it's their cap size, the therapeutic space that they're involved in, is it a hot space, management teams that we know are willing sellers, do they have commercial ready assets, or do they have the most innovative assets, best in class, first in class? And this has been an actively managed basket over the past 30 plus months now, in which we rebalanced and repopulated the basket over a dozen times during that period. And you can see here really the material outperformance since inception to the midpoint of this fiscal year, with a nearly 70% return for our basket versus 25% for the XBI and 19% for the NBI. So why has M&A inflected? Well, it's been for a number of reasons. First and foremost, and we've discussed this all year, but large cap pharma is facing another large patent cliff, very reminiscent of the early 2000s. But this case now to 2030, a number of major blockbusters will be losing their exclusivity, and sales of these products will substantially erode, up to a quarter or even over $250 billion, leaving major gaps in revenues and earnings for a number of the large cap companies. Second, as Sven discussed, drug price reform is here, at least for now, and lower drug prices for Medicare will take effect in 26, and that's just going to further pressure top lines of many of the companies in the second half of this decade. Third, and importantly, small cap biotech valuations are still at basically all-time lows, a little bit off the bottom, yet at the same time, biotech innovation is at all-time highs. And now with Republicans in control, we'll have an imminent removal of the current FTC commissioner, as Sven alluded to, who has tried to block numerous and prominent healthcare deals during her tenure. So her departure is another green light for M&A to accelerate post-election. So is there more to come? Yes. And why is that? Well, in addition to what I've just explained here, large cap executives keep telling us they're going to do more. From the start of the year to the quarter that just wrapped up, management teams have continued to talk up the need and desire for M&A. We had 33 deals in the first 33 weeks of this year, ahead of even last year's incredible pace. That said, we've been through an expected summer seasonal slowdown in M&A more recently. And executives also said they will wait for post-election before resuming M&A. So that's where we're at now. So stay tuned for post-election and hopefully a 2025 inflection in M&A. And importantly, we expect this to be a major theme for us in the portfolio going forward into 2025. Switching gears a little bit, an update on the U.S. Food and Drug Administration. Of course, this is a critical legislative and regulatory component of the healthcare industry, and I can report that the current situation at the FDA is very positive. 2023 was a record year, and 2024 has continued as well, on track for over 50 approvals this year. We've had some very landmark approvals in Alzheimer's disease, a new product for pulmonary disease, a best-in-class pneumococcal vaccine was approved earlier, and a novel T-cell therapy technology for a type of skin cancer was also approved. But what's most impressive about this slide here is almost 450 new drugs approved over the past 8 years. This has been the most productive time the industry has had in over 20 years, despite the hurdles for a new drug approval that keep getting higher and harder to achieve. And yes, we'll have a new FDA commissioner with the new Trump administration. But I would remind you that this inflection of FDA approvals really coincided with Trump's first term in office, starting in 2016 and into 2017, where he believed that the best way to control drug prices was really through competition. And the best way to increase competition was to approve more drugs. But again, still a hallmark of industry innovation. So what else drives the stocks higher? Simple, it's innovation. And the number one category by far remains diabetes and obesity, or diabesity, as we like to call it. And I have to say that over the past year, the client calls that I've done, 90% of the questions we get are on this topic. Some calls, that's all we talk about. But what's really interesting to point out, this is a 20-year-old class of drugs. Yes, it's taken the market by storm in 23 and 24, but I still think we're just getting started here. I think the big question for 2024 was on supply. How much of these drugs could Lilly and Novo make? We still don't really have that answer, but we do know that they will sell all they can make. The demand continues to be insatiable. The companies have, Lilly and Novo, substantially raised their sales guidance twice already this year. This last quarter, they had to pump the brakes a little bit as supply constraints took over, but while approving, but they're still maxed out for 2024. But I also point out this, Lilly and Novo combined have guided to investing close to $40 billion over a 5-year period to build out global manufacturing capabilities. This is not a trivial undertaking by either company, and we should see evidence of these efforts in 2025, including Novo's acquisition of Catalent, should it close, which we expect it to do so. Second, on this slide, I'd like to point out that global launches have so far been very small and calculated, only a handful of countries in Europe. And again, this is due to supply constraints, but patients in those markets have lined up to pay out of pocket so far for these drugs, and we expect an inflection there in 2025. Compounders, this has been a big story here in the US, but these companies have been a real thorn in the side of Lilly and Novo and have taken a material share of the market, but I think that comes to an end in 2025. And life cycle management and competition are full steam ahead in obesity, but we think the leaders in next-gen injectables and oral alternatives really remain Lilly and Novo themselves. But really the long-term driver of this class of drugs is not really so much weight loss, but indications that we think can drive material improvement in your health. And this was an interesting slide that we put together. Almost all of this data has come out this year or late last year, but this slide shows some of the pivotal data where GLP-1s have already shown substantial clinical benefit beyond diabetes and weight loss, such as reduction in heart attacks, reduction in strokes, lowering your risk of dying from a cardiovascular event, reduction in kidney disease, improvements in heart failure, improvements in sleep apnea, improvements in pain associated from osteoarthritis, and most recently, just last month, improvements in liver function in patients with liver disease. And incredibly, across many of these trials, it appears that GLP-1s are almost perfect in preventing diabetes in obese patients. That is, patients on GLP-1s who are pre-diabetic can prevent progressing to diabetes. That is really an incredible thing to say. And so while many debate whether weight loss is a fad or not, and are we peaking out from that perspective, these types of health benefits across so many other disorders, we think can help drive long-term sales growth of this class of drugs. And that's what we've tried to depict here is the total addressable market is really huge for all of these additional indications. Approvals here, and this is also very important, approvals here also aid in reimbursement, patient access globally, and certainly creates barriers to entry for future competitors who may try to enter the fray only with weight loss data themselves. And finally, a word on medical technology, which has really been an outstanding contributor for us in 2024, and we expect that to continue in 2025. Really largely on the heels of innovation in this space as well, and long duration product cycles. You know, we've talked about Boston Scientific previously in the incredible launch of their atrial fibrillation ablation system. The growth there is top tier in the med tech space. And Intuitive Surgical, we've been waiting for this, but we finally have the recent launch of their long-awaited 5th generation robotic surgical suite. The first quarter of sales and demand and performance was really stunning, and that pushed that stock to an all-time high. But importantly, we think it continues into next year. Sven asked me to discuss performance, so I'm going to move to that now. And first, I'd like to review the fiscal half-year performance, specifically the 6-month period that ended September 30th, and that was the original point of doing this call. And you can see here we have both positive absolute and relative return of 60 basis points above the benchmark during this 6-month period. You know, really, there was 3 periods of volatility that really contributed to the shape and performance across this period. First, here you can see at the very start of the period, we had a macro sell-off. Inflation data was a little bit hot. Interest rate expectations waned temporarily, but this was followed by a very quick recovery of performance, an extended period where we put some real outperformance on the board into early July, fueled primarily by stock picking. We saw that collapse a little bit in late July, another macro sell-off there. That was triggered really by tech stocks in which retail favorites were sold, year-to-date laggards were bought. This compressed a little bit of our performance in late July and early August. But once again, my apologies, once again, we're able to rebound from that as healthcare turned defensive in August. But again, some important solid earnings reports within the portfolio really helped boost performance. And then the third compression was here in September, just ahead of the election, where I think there was some de-risking in healthcare ahead of the elections. And you can see here, sorry, I hit the wrong button. You can see here the biggest winners for us during the period came out of services and med tech. The latter through some really great stock picking. And China got a nice late lift through the end of September. Pharma during this period, we saw a little bit of reversion to the mean towards the back half of the 6-month period. And in biotech, mostly allocation effect as we saw a bit of a pause in M&A. But we also wanted to show you the calendar year-to-date performance. This is performance from January 1 right up into yesterday's close. Now the performance is double digits. Our total return NAV is 12%. And the spread between the benchmark has widened considerably from 60 basis points to almost 3.5% or 350 basis points over the benchmark. And you can see a little bit of a post election rally in healthcare at the tail end of this year. And finally, this slide shows our cumulative performance since inception as we approach a special year for the trust, our 30th anniversary in 2025. And a couple of things I would highlight here. First, a nice bounce back in performance in the last couple of years after some volatility in 21. And this is a real hallmark of our history, I believe, the ability to persevere through adversity in healthcare and not waver from our long-term recipe for success. And with that, we were able to post a new record high earlier this year, and hopefully we can do that again next year as we celebrate our 30th. And with that, I'll hand it back to Sven to discuss positioning.
Okay, thank you, Trevor. So what have we done actually in reaction to the developments here in the recent days? And I think here, very important part, is like where is our leverage? We have geared up a bit. I mentioned before, with this 2-year underperformance of healthcare in general, and the political headwinds turning into tailwinds, we thought it's very timely actually to increase gearing. So we geared up here. But there have been changes within the portfolio as well to adjust for the change. And you see here, our exposure by subsectors. This is actually this is as of last night. So we have further increased our exposure to the more innovative parts of the healthcare sector, so biotechnology, medtech, pharma, and we have a little bit reduced on healthcare services, a little bit on tools in Japan and in Japan overall. So, this is the key to our long-term recipe of success has been always innovation and growth. With this environment, I think what we are seeing in the market right now, we want to be more exposed to innovation and growth. And if you look at the portfolio, this is as of September 30th. We report our holdings twice a year in the annual report and at the half-year result. I can tell you a couple of important changes since then. Maybe here on biotechnology, I would highlight the M&A basket, which Trevor talked about. That's our largest holding in the fund. We think this is going to be very, very important contributor here into year end. We have additionally increased some biotech exposure here in anticipation of M&A into year end, the turn of the year. Pharmaceuticals, we have adjusted a bit here on ASI, Merck as well. We reduced Merck. Healthcare services, very important. Elevance, we have sold. United Health Services, we have sold. So we made quite a few as well under the hood adjustments on names within the subsector since our mid-year update. Overall on the portfolio characteristics, it's a very actively traded fund. So, active share of 68%, but top 10 positions, they do represent a very, very important part of the portfolio. So our biggest positions, M&A baskets, Eli Lilly, Boston Scientific, they have been all very important positive contributors in the current fiscal year. And this gets us to our playbook. And the important message is here. We do believe that the 2-year underperformance of healthcare versus broader market will narrow. That the election in the United States is an important tailwind now going forward for the next 4 years. We think the right recipe for success continues to be innovation and growth especially under Republican administrations here in the United States. And I'm very, very optimistic that we will possibly see here a year-end rally into January on the back of some additional M&A transactions. And with that, I see already we have a whole number of questions queued up. If you do have any questions, type them in. I will read them out, and then we will answer them one by one between me and Trevor. So let's see. First question here is, Pfizer and AbbVie haven't covered themselves in glory with their recent takeovers. Isn't this likely to suppress large bids in the sector? Well, I think Trevor answered that question. It's like there is a really important strategic rationale for large cap pharma to continue with this trend. So I think large cap pharma needs revenue growth, and the only way they're going to get that in the 25 to 30 period is through M&A. While I think the question is correct, AbbVie, they made two acquisitions last year. One was for Immunogen, the other one for Cerevel. They had a major failure on Cerevel last year that turned into a zero. Pfizer made a number of acquisitions. They probably have stopped with new acquisitions because they're simply tapped out on the balance sheet. They made so many large acquisitions, especially Seattle Genetics. And then I think the windfall from COVID stopped both on the vaccine front and on the antiviral front. So Pfizer doesn't have the balance sheet flexibility what some of the other companies have. But overall, I think this is not going to be a change of the trend. I think it's going to be even more. I think AbbVie has to do more acquisition because they have to, replace the Cerevel failure yesterday. Next question. Or would you anything from you, Trevor, Pfizer, AbbVie on large cap pharma?
No, as you were answering the question that your points at the end there, I was nodding in agreement, Sven. I think if anything, this puts further pressure on companies to continue to do it. And the rest of the industry, I've been very surprised at the consistent talking point around senior management across the quarters. It started in January, JP Morgan. Not only the deals they announced, but how they talked about the need to do deals. And we follow with management every quarter. And one of the things I do immediately is I relay all M&A comments to Sven as they come through live. And they haven't slowed down. They haven't trickled. It hasn't abated. So we did go through a bit of a pause, but I believe it'll flex significantly late this year and into next year.
Yeah, we have a couple of questions, all a little bit similar related to politics and M&A. Maybe we move through them a little bit quicker. So of the main impacts from the election results discussed, which are the most impactful specifically for small cap biotech, and similarly, which are most impactful for large cap pharma? How is the trust position for this? And let me answer the small cap question. I think the most important one is change at the FTC with Lina Khan will resign or will get fired in January, and this will open the floodgates, I think, for M&A. And I mentioned before we increased our exposure to biotech tactically for, I think, a possible year-end bolus of M&A. Trevor, do you want to answer it on the large cap side?
Yeah, sure. I think for sure the biggest overhang for large cap stocks through the Biden administration has been drug price reform. That came to fruition. We've seen some of the systematic negotiations that have occurred, and let's face it, they're not negotiations. They're actually, it's price setting by the government. But I think the most important outcome now with the Republican sweep is none of that legislation that is now law will get worse. And if anything, it can only get better under Republican control. Sven already mentioned correcting what we call the pill penalty, which is small molecules getting penalized through only 9 years of exclusivity. We think that will get adjusted under the Trump administration. And we'll see. Parts of IRA, I think, might get amended. There's some potential that the entirety of it gets repealed. But the biggest positive, I think, is the absence of any further negatives. Not that there's an all clear horn, but I think, investors will not have to worry about drug price reform going forward, getting worse. I think that's also a positive in terms of our M&A theory as well. So I think that's sort of been the biggest delta. But otherwise, in large cap pharma, fundamentals still really drive the ship in those companies, and we've seen some disparate share price moves. And I think the fundamentals of the companies with the best pipelines can continue to outperform in the long run.
Okay, next question is, do you have a preference between small cap biotechs, smaller than $2 billion market cap, and mid cap biotechs, market cap between $2 to $10 billion range? It's a great question, and my personal preference is mid cap biotechs. If you look at our portfolio, the names that you see there are mostly in the mid cap range. I think the M&A activity, the sweet spot is this $2 to $10 billion range. That's where we see, I think, a lot of the speculative momentum and possibly the takeouts. Smaller cap stocks, they are represented, by the way, in the M&A baskets. That's why we grouped these together, and there are many smaller caps in there. But I think our preference is for this in biotechnology in this mid cap range. Now, next question is, given the positive outlook for M&A and the better background generally, do you plan to skew the portfolio further down the capitalization range scale? Yes, and we have done it already. Since the quarter end, September 30th, we have further increased, I think, the biotech. So a lot of our tactical moves have been actually going out of some international names and some non-biopharmaceutical names and large cap names, and moved it more into the higher octane part. Next question, that's a great one. You reference Lina Khan departure as a positive. What do you make of JD Vance praising Lina Khan in recent months, and the fact that her replacement is vetted by a Vance aide? Look, at the FTC, there's always going to be Republican appointees and Democratic appointees, and one thing is very, very standard. The Republican appointees are always industry friendly. Democratic appointees are always the opposite, and I think we're going to see a continuation of the trend. I think what has been said during an election campaign, there's certain aspects, maybe what JD Vance likes about Lina Khan, but I think she's universally disliked by both industry and by Republicans. I think she is in the crosshairs of everyone in the new administration. Maybe next question is a good one for Trevor. Do you expect Trump to attempt to unwind the ACA again? How important is the choice for HHS secretary?
Yeah, that's an interesting question, what Trump will do with ACA, reaching back that far to do something there. That hasn't been a talking point through his campaign at all. He's talked a little bit about drug price reform, but what has been very interesting throughout the campaign for both candidates is how little healthcare was discussed. So I don't think that's a first 100-day type opportunity. But the one thing that I'll remind everyone on the call is when Trump did try to do something about drug pricing, his focus wasn't on the manufacturers or the sources of innovation. It was the middleman. It was the PBMs, which were taking sort of more than their fair share. I think that's where his focus was in the past. And I think if he resumes that effort, I'd be interested to see if that is his primary target rather than ACA and exchanges. But yeah, there is some volatility around ACA and what Trump might do, especially with complete control of Congress.
I think we have two more questions. Maybe next question for Trevor as well is, we have seen AstraZeneca have a significant fall in share price in the last couple of months. Do you have an opinion if this is fully warranted, or do you see this as an opportunity?
That's a great question. It's a spot-on observation. The share price has moved down considerably. Quite frankly, I see this as a real opportunity for two reasons. The two main sources of share price pressure, one comes from the pipeline of an ADC that they've partnered with Daiichi Sankyo called Dato-DXd. This is a new potential treatment for various forms of lung cancer. The initial trial, unfortunately, had some mixed data. That data was compounded by AstraZeneca's new biomarker. This is an ADC that is directed against something called TROP2. I won't go into those details, but at the time that trial started, they did not have this biomarker that AstraZeneca subsequently developed it. So they're going to have to rerun that initial trial, but that doesn't mean this is a bad drug. It was just a bad trial design. And I think the opportunity for Dato-DXd is still significant. The trial in question was a late-line trial, which is typical in cancer development, that you start with the most difficult to treat patients until you move into earlier lines of therapy. So I think there's still a big opportunity for Dato, for Astra and Daiichi, and it's completely out of the price. The other pressure point for AstraZeneca, of course, has been China, with the most recent headline, which was quite frankly a scary headline, that the head of China operations at AstraZeneca was being detained. But what do we know now? We know that the government authorities in China have not pursued AstraZeneca as a corporation for any fraudulent dealings. They pursued only individuals at AstraZeneca, primarily sales reps, who were trying to get AstraZeneca drugs to patients who were not who did not have reimbursement or access. AstraZeneca hosted a call this morning on their quarterly call. I listened to that ahead of this call. They scant on details, but the share price move again, with respect to the magnitude of China, is incommensurate. China is a big part of AstraZeneca sales at 13%. The share price has moved down more than that in response to this news flow. I think that's unwarranted. It's also just oncology, which is only about a third of China's sales, so maybe 5% of total AstraZeneca sales. And importantly, emerging markets growth for AstraZeneca is more than just about China. China represents slightly less than half of their total emerging market sales. The other half is growing steadily. And AstraZeneca is one of the most diverse pharmaceutical companies globally in terms of the number of therapeutic categories they're involved in. The valuation is compressed. So I absolutely think this is opportunity rather than a risk going forward.
Okay, we have three more questions, and let's see. So we have one in the medtech space. You mentioned robotic surgery, intuitive surgical. How far along is this? Are any surgeries automated already, and what are the expectations for the next few years? Well, I think robotic surgery is already here and there. You know, if you would think back over the past 30 years of the existence of the fund, one of the major innovations has been actually the advent of the intuitive surgical robots. You know, they are now they just had a major new product introduction earlier this year. You know, there's certain disease surgeries like a hysterectomy or a prostatectomy, like a prostate removal, or uterus removal, they're really done. It's almost malpractice not to get it done with a surgical robot. I think surgical robots, in particular, Intuitive Surgical is the dominating company there. They will take over more and more and more of surgeries. I think 30 years from now, I could see an environment where every single surgery is just done by robots, because they are significantly more precise, significantly smaller incisions, and that is clearly the future. So we're very, very excited about those prospects. When it comes to Intuitive Surgical, the only question is, it's a very, very highly valued company. This is one of the biggest momentum names inside healthcare because of the domination what they have in that space, and it's widely recognized. But this is a company, they're growing top line revenue, the procedures by 20%, so extremely rapid growth, and a very, very good chance, if anyone in the future has to undergo surgery, that they will be operated on by iSearch robot. Then two more questions. So what is the percent of your biotech portfolio is in precision medicine companies that is linked to genetic markers? How important do you see this theme? Well, I think every company, even large company, they have they use precision oncology genetic markers for their drugs. Good example for that is AstraZeneca. Their biggest selling drugs are targeted oncology drugs. So this is an important part of the industry. But I think one thing is as well, targeted oncology has become a little bit a dime a dozen for small cap biotech. There is intense competition, and so at the moment for small cap biotech, it's not the most favored subsector. So I think you have to be extremely selective there when it comes to targeted oncology companies. If your question is on more on gene therapy, gene editing, which is very, very popular as well, that is as well a little bit out of favor. So I think in terms of sweet spot for biotechnology companies, I think it's in other areas. It's almost, the industry is so widely accepted, and they moved on to the next hot thing. So precision oncology, gene therapy, gene editing, that's just simply part of the tools what every pharma, every biotechnology company has. And last question, I maybe let you answer it, Trevor. What are the risks around RFK Jr.?
That's an interesting question. Well, I mean, obviously, RFK Jr. has had a public spotlight for a long time. And one of the reasons he gets that spotlight is, as Sven alluded to, he is an outspoken character. He does have a very important following. He does make remarks that are a little bit out of bounds at times. But I think on a more practical level, one of the issues that he might be most concerned about is vaccines. I don't want to use the term anti-vaxxer, but he's had concerns about vaccines. That could be an area of focus for him. As Sven also alluded to, part of the FDA is food consumption, food safety, food equality. That's also going to be a big topic for him. But I think at the end of the day, from what we have learned with our internal political expertise, political consultants, that RFK will be more of an advisor in the Trump administration rather than an appointee. So therefore, while he's an opinionated person, I think his overall power is going to be limited outside of attempting to shape policy by having President Trump's ear. So it's something we're watching, something that we've articulated as a potential negative going forward. But right now it seems like a little bit more smoke than fire, but we'll take a wait and see approach.
I think with that, we've come to the end of the Q&A session, and I want to thank all of our investors for listening in and being supportive of the Worldwide Healthcare Trust. And with that, I maybe hand it over to Matt.
No, again, thank you very much, Sven and Trevor, for your time today and the update. And just a thank you to all those who've been listening in. And if you have any further question, please email ir@frostro.com. And we very much look forward to the next update. So thank you very much again, and see you next time.
Cheers, everyone.